Hello and welcome. You're tuned into CNBC-TV18 Prime. Let's get cracking on a brand new edition of The Big C. I'm Manisha Gupta and with me is Nigel Dsouza, bringing you your daily dose of commodities, currencies and cryptos. But what are we discussing today, Nigel?
Well, lots on the radar, Manisha, with all the cues that we have overnight. And all eyes will be on the dollar index. This as the greenback has now plunged to an over a 3-year low. What does this mean for the commodity space, especially gold as well as silver? We'll take that discussion forward over the next half hour. We'll have guests who will be joining in. Sunil Kashyap of FinMet will be joining in, and Osama Rizvi of Primary Vision will be joining in to make sense of the current construct as well as the way ahead. But before we get to that discussion that we have lined up for you with our guest on the show, let's take a quick check on how the global markets did overnight. It was a lackluster session on Wall Street, but all the three indices, they are set to close in the green for the week. The S&P 500 now is merely 1% away from its highs that it scaled in February. Keep in mind, the S&P 500 in the month of April itself was close to 20% away from those fresh all-time highs, and probably in today or tomorrow's trading session will be back at those record highs. Stock futures are indicating a start around the flat line. Well, what's going to be important to watch in the US market will be the macro data coming in from the United States. The Q1 GDP print and the personal consumption expenditure for the month of May will be due. The street will also be keeping a close eye on all the earnings that are expected out there. We have Nike as well as Walgreens that will be coming out with their set of numbers. And sticking with the equity markets, well, it's a bit of a mixed session coming in for the Asia Pacific. A robust close on the Japanese market with the Nikkei notching up gains of close to around 1% by the time it wound up. But the moves of the Shanghai as well as the Hang Seng were largely tepid. Coming back home on the Wall Street, well, it's a solid day of trade. Remember, it's expiry that plays out here in the Indian equity markets. The Nifty continues to hold above the 25,400 mark, but all eyes are on the dollar index, which seems to be in a downward spiral. Manisha, tell us how you're seeing the trends on the dollar index. It's just moved lower. I recall when President Trump took office, it went dancing away to 110, and from there, it's been a one-way slide.
Oh, well, absolutely. I mean, this is the worst first half year that you've seen in many, many years when it comes to dollar index. Well, just as the sentiment was recovering following that ceasefire between Israel and Iran, the U.S. President Donald Trump has found a way to rattle the markets yet again. Through his latest jibe at the Federal Reserve Chairman Street, he is again left fretting over the central bank's independence. Reports are now suggesting that Trump could, in fact, name Powell's replacement as early as the month of September. The news flow has triggered yet another bout of selling in the greenback, pushing it to its lowest level since 2021 against the euro as well as the pound sterling. Meanwhile, on his second day of testimony to the U.S. Congress, the Fed Chair Jerome Powell reiterated that the central bank should keep interest rates on hold on expectations that Trump administration's tariffs will increase inflation. Let's listen in.
We've been through a long period in which tariffs were going down. Remember, since World War II, really, it's been a process of lowering tariffs globally. So there just isn't a lot of modern learning on that. I think people look at the incidence of tariffs during the president's first term, but those were like 1/6 the size of what's people are estimating now. And they do find some effects on inflation. But remember, in 2019, when those tariffs were put into place, the economy was slowing. We actually cut rates 3 times. Inflation was running at 1.5%. So it was a very different time. This is different. I think one of the reasons why it's so challenging is that there really isn't a modern precedent. And I think we have to be humble about our estimates. And we are very open to the possibility that transmission through into inflation will be less than we think, or maybe more than we think, which is why we're in a position of wanting to take our time and make a smart decision as we see how this unfolds.
Oh, yeah. Powell says wants to take time and make a smart decision. And, well, this is the kind of time that he says he wants to be humble when it comes to estimates going forward. But shifting focus away from the money market, the oil witnessed a 1% spike overnight, extending gains from the previous day as a larger than expected crude draw in the U.S. inventories kept the prices afloat. Remember, crude has declined 13% in the last 2 previous sessions, and yesterday was a good day. Meanwhile, the street continues to exercise caution when it comes to the tensions in the Western Asia. While there seems to be some semblance of easing after the ceasefire, but Trump commentary from the NATO summit has triggered renewed fears of conflict resuming between Israel and Iran. Let's listen into what the U.S. president had to say on this.
They fought very, very hard and very viciously, very violently, and they were both satisfied to go home and get out. And can it start again? I guess someday it can. It could maybe start soon. You know, Iran has a huge advantage. They have great oil, and they can do things. I don't see them getting back involved in the nuclear business anymore. I think they've had it. They've been at it for 20 years, and I don't see that happening either. Now, if it does, we're always there. It won't be me. It'll be somebody else, but we're there. We'll have to do something about it.
All right. Well, on that note, let's shift focus then to the precious metal space. Keeping in mind a weak US dollar, prices of silver as well as platinum, both of them are rising. In fact, silver is up closer to 9% just this month. Platinum is trading at the highest level we've seen in the last many, many years. So let's welcome our first guest on the show. We have Sunil Kashyap, the director at FinMet, who joins us. Hi, Sunil. Good day. Thanks a lot for joining in. Well, what are you making in terms of, first, let's talk about gold prices. You know, they came down a little bit. They've seen a big, big run. They've done actually outbeat many equity market stocks, actually. It's up, what, more than 40% just in the span of 2 years or so. What is your view in terms of gold? Fundamentals taken into account, the weaker dollar index, as well as the global uncertainty. Please go ahead, Sunil.
Yeah, there's a lot to unpack there, and lots of things happening. So I think where we are right now is that we're in a consolidation pattern. We haven't seen gold prices go up as much as people are expecting. I think we're consolidating at these levels. And gold right now is driven by two factors. On the one hand, as you mentioned, Chair Powell is making sure that inflation doesn't get out of hand. So if inflation doesn't go out of hand, gold becomes more subdued. So that's why you're seeing it moving slightly on the downside. But on the other hand, the dollar index is becoming weaker. And so normally when dollar becomes weaker, gold becomes stronger. So that's the reason why we're in this sort of a jam right now where gold is not pushing lower because of reduction in inflation and not pushing higher because of dollar weakness. It's sort of stuck in a pattern. On the other hand, what we are seeing is silver and platinum are reacting. You know, these two white metals are industrial metals. And for a long time, as gold was running up, both these metals were subdued. Silver was trading around $30 and platinum around $1,000. And what we've seen in the last 2 months or so is they've broken out of their shell and they're sort of exploding to the upside. I think market generally does expect more upside on silver. Platinum has already moved almost 30% in the last 6 weeks. And so I think that may go through some consolidation and maybe some pullback, but silver, everyone's looking at and talking about $48, $50.
Oh, well, absolutely. That's the kind of reports that we've seen, Sunil, coming in from Bank of America, Citi, Saxo Bank, even JP Morgan for that matter. $38 to $40 an ounce as conservative targets for this year by the time this year ends. How are you looking at, let's say, next 3 months, 6 months, 8 months period when it comes to silver? And especially since you're at it, why don't you tell us on where is platinum and gold heading as well by the time we end this year?
Yeah, I think there's 2 periods now. So we're going to go through a summer right now. The markets were frantic this year. I think the summer months are going to be a little bit of a respite. People are going to just take it easy. So you may see some range trading in the metals for the next 2 or 3 months. And then come September, if the news of the Fed comes out in terms of the new chairman, and then the impact of the tariffs comes in, you'll see more volatility. Overall, silver, I think, like you said, is going to end higher. Platinum, I think, is going to be range bound, and gold should move up. The typical targets for gold for the year end, people are talking about is 3,750 to 3,800 on gold.
You know, Sunil, in the past, we have seen that one of the assets do well. You know, sometimes the equity market is a little bit brittle, and then gold does well. Actually, right now, it's a party because you have equities that are doing fairly well. The US market's case in point, you know, it's recovered, what, 15-18% since the lows that we saw in April. And gold is holding rock solid as well. So how do you see this panning out? If you have buoyant equity markets, do you expect gold as well to move in step?
Yeah, I think this, on the other side of the coin, people are a bit worried saying, you know, which shoe is going to drop? Is it going to be the equity markets? Is it going to be commodity markets? It's going to be the bonds. And I think given that fact that you don't really know what's going to happen in the next few months, what the impact of the tariffs will be, I think the right strategy for a prudent investor would be to diversify. You look at a sort of a mix, equities, bonds, and some amount of commodities, largely gold, of course. And that diversification is the way to go right now because you don't know how things are going to play out in the coming months.
So, Neil, since you talked about US and US doesn't seem to be servicing its debt, it's actually rolling it ahead. How would you read that in context of gold? And the other thing is because we haven't seen gold move at all, whether it's about geopolitics or whether it has been about various other issues which seem to be impacting the markets right now. Would you say gold in some sense right now has factored in a 50 basis point of a rate cut? Point I'm making is, has gold factored a lot of things right now?
Yes, I think there's two things. Firstly, the US is very interesting. What you are seeing is again a bipolar situation where foreigners view the US markets very differently from the US investors. So you're still seeing in the US retail investors plowing money into the equity markets. Every dip gets bought into. There's a lot of frenzy whenever there are dips in the market, retail investors come in and buy. There's a lot of positive sort of sentiment in terms of retail investors within the US. However, if you look at institutional investors and foreigners, I think they're much more cautious and they're pulling money out of the US equity markets and moving it overseas. And that's why you see markets like India, like China, Korea, Japan doing so well. So I think that situation has to be kept in mind that there is a fleeing of foreign money from the US markets. In terms of gold, what you do see is, like I said, there's two factors. You're absolutely right that I think people are factoring in the fact that inflation is not going to be that much of a worry and the Fed is going to reduce interest rates. And that's why the sort of fear of inflation that moves gold higher is going away. But at the same time, like I mentioned, the weaker dollar would normally mean gold prices should go higher. So gold is now stuck in a range between the downside movement versus the upside movement. And so that's why you're seeing it being consolidated at this level. Medium term, it still is a good buy. We're still in a very risky kind of environment. So in terms of a diversification, like I said, it still makes sense to hold some amount of gold.
Between the three assets, that we just discussed, we'll keep equities and bonds out of this, but, we just spoke about gold, silver, as well as platinum. If you were investing, putting fresh money to work right now, how would you allocate all these three?
Yeah. So I would still say that gold continues to be a diversification. So if you are looking for shelter, we know gold over a long term play has a negative correlation to the equity markets. So gold should be part of your portfolio, and you should be looking at keeping some amount there. But if you are speculative in nature, if you feel that you're looking for an upside, and if you believe that industrial growth around the world is going to remain solid, then the way to play that game is to buy metals which are industrial metals. Copper is one of them, silver, and of course, platinum. But keep in mind, platinum has run up quite a lot. So I would say if you do believe that there is sort of a solid future industrial growth out there, then buy silver, buy copper.
So, Neil, coming on the dollar index itself, and as we've been saying, it's trading at a 3-year lows right now. We've seen 9% of a decline in this year. It's trading the worst of first half in many, many years there. And we've seen pound sterling, we've seen Japanese yen, we've seen Chinese yuan do actually positive within the same period. One, where do you see the dollar index decline up to, given the kind of scenario that we are in? And some people have been championing, cheering for a further dollar decline from here on. And how much of an impact of that would we see in many of these metals that you just talked about?
Hmm. It's quite interesting. Like I said, I think the biggest factor why the US dollar is declining is because foreign players are moving money out. You've seen movement back to Taiwan. by the Taiwanese insurers out of the US and moving it back into Taiwan. Similar movements in Europe, similarly in Japan. So that's the factor which is really driving the dollar weakness. But the interesting thing for me is, usually in the US government has a strong dollar policy, and you have the government's taking and the Fed taking, or the Treasury taking steps to try and strengthen the dollar. It's interesting that right now, besides some weak statements, you don't really see anything solid coming out of the US saying, no, no, we'll do whatever it takes to keep a stronger dollar. So what that shows to me is that maybe the US doesn't mind a weaker dollar because they feel that, the exports are going to become more profitable for them, and therefore this is a way in which they can curb imports and grow their export market. So this seems to be a shift compared to the policies of the last 20 years or so. And I think that's why the movement of the dollar weaker would carry on little by little over the next few months. As far as the impact on gold is concerned, it's definitely positive for gold. So as far as the metals or gold is concerned, we see that as being positive. A weaker dollar would result in stronger metal prices.
Sunil, before we let you go, I'm going to push you for a level in case of dollar index as well. We've come down all the way from 110 plus kind of levels to 97 right now. There are reports suggesting 94 or even below. What's your own sense?
Yeah, I wouldn't go for a level, but I would just say to investors, this is a trend which is not changing. It's not as if people are looking for a particular level. You are going to see the erosion of the value of US dollar against currencies, especially against other developed currencies, the euro, the yen, Swissy, uh, even the Singapore dollar, for example. So this is a process which is going to carry on for multiple months. We're not looking at any kind of target right now, but this trend continues to be weaker dollar.
Sunil, you're not giving us a level, but can you tell us on what percentage decline can we expect? 3 to 4 to 5 to 6%?
I think you're looking at 120 on the euro, okay, which is 3 to 4%. And similarly, you may find if the currencies get too strong, then the respective governments are going to come in and try to come in and push the currencies weaker again because it'll impact their export markets. So, but at least for the time being, it does look like 3 to 5% is a further decline expected.
Point taken. Thank you, Sunil, so much for sportingly answering all those questions and appreciate your time here with us. And with that, it's time now for a short breather on the show. We'll be joined by Osama Rizvi on the Primary Vision. Stay tuned. Welcome back. Let's now welcome our second guest, Osama Rizvi. He's energy and economic analyst at Primary Vision. Osama, hi. Thank you so much for taking time out for us. And the first reaction clearly on what the macros seem to be telling us on the currency side of it. We've seen dollar index decline. The other currencies seem to be doing well. And within all of this, we've seen a huge push come in from China on putting their currency where it matters. We've seen Chinese yuan gain up by 2% in this year, while the dollar index, of course, has seen a decline. How would you look at China maneuvering on what it's doing?
Well, thank you so much for inviting me on the show. First of all, we need to look at what were the reasons behind the recent fall in dollar index. The main linchpin, the foundation of a stronger dollar, of course, is the confidence in the US economy. And I'm sure we will talk about it in the interview. That seems to be eroding a little bit, if not by by a lot. So I think that was the reason the big budget bill, the debt crisis, the debt ceiling crisis, the consumers, they're not doing really well in the US. So all of those concerns have led to a decline in that dollar index. And on the other hand, China seems to be doing really well. When we talk about the macroeconomic indicators, and I've been tracking them from previous few weeks very diligently in terms of EU, US, and China. And Chinese economic indicators are the only ones that seem to be giving a positive outlook. Guaranteed that they've had their issues recently in terms of increasing fixed investment, in terms of increasing retail sales. But recently, the figures posted were quite positive. I believe that has also given China some confidence in terms of maneuvering its currency.
Hi, Osama. Good to see you in. Thanks a lot for joining in. Well, a quick couple of questions. The US economy, as you said, data points are pointing out that maybe the second half of the year will be a little bit softer. What kind of growth estimate are you working for the US economy, say for this calendar year, 2025? And also, there is that fear because of tariffs and various supply disruptions. Actually, inflation is going to perk up as well, which could be a bit of a worry in terms of Fed action. So tell us on both these two counts, how do you see things panning out?
That is a very, very interesting question. You see, so far we have had different theories. Uh, there was a recession, it was coming, it was foreboding, and it's been almost 1.5 years. We have not seen any recession in the US. On the contrary, the GDP growth, the quarterly GDP growth have remained somewhat strong. But there are other theories right now in place, very interesting ones. For instance, some say that there is a rolling recession in place, which means that this recession is specific to certain sectors. Some say there is a wide recession in play. This was in Forbes a few weeks ago. And that means the sentiment part of the businesses, that is not doing very strong. Um, at Primary Vision, we're looking at the real macroeconomic indicators. We're looking at the conference boards, the leading indicator. We're looking at the Atlanta Fed GDP projections. We're looking at other such factors, and all of them point towards underlying problems. There have been some positive aspects, but when you look at the PMIs, you look at the manufacturing PMI, it was in the negative or contractionary territory for over a year, and it recently started to just take a positive turn. And if you look at the consumer, the US consumers, that is where the problem lies. Credit card debt, $1 trillion. Delinquencies at multiple year highs. You have Yale Budget Lab forecasting that the impact of tariffs on a common household would be anywhere about $4,000 to $5,000 in loss of disposable income. And according to recent surveys, the number of people who can manage a surprise expense of $1,000 have reduced to its lowest level in recent years. Yesterday, the consumer confidence index was also came out, and although it ticked up a little bit in the previous reading, it has fallen once again. So all of these factors make me believe and point towards problem lying ahead. Of course, we're looking at somewhat growth, but it would definitely be more contained. And I am expecting, if not a recession, but a prolonged period of stagflation, because that is what we're facing right now in the world at a large as well, and in major economies as well. And when we talk about Fed is in the pickle. I believe, and I've done some criticism against their policies as well, especially post-pandemic. But right now, maintaining rates is actually a good decision, because it is too early to call for a win against inflation. We have underlying inflationary elements right now. We just had the Israel-Iran war. The tariff situation is still there. People don't get it. We have the highest level of real effective tariffs since 1938
Oh, absolutely.
in the US.
Osama, just interjecting there, an interesting point you make on living in difficult times, and a recession perhaps is rolling, and recession perhaps is in various sectors at this point in time. Clearly a situation that we haven't seen in a very, very long time, ever perhaps. But coming on the crude oil prices also, because that really has been a headline for last many, many days. While we do see some consolidation, but that's been only 2 days now, too short a period to call it a consolidation. What would you want to watch out for crude now in sense of fundamentals and factors? And what is your sense, short-term and long-term crude price forecast?
Well, I've been, calling for a bear market ever since before the war as well. And there are fundamental reasons for that. So let's look at the fundamentals. We have a supply overhang of anywhere between 800,000 barrels per day to 1.2 million barrels per day. And this varies according to EIA or IEA or OPEC, but there is a supply overhang. And then the demand is not there. We've just talked about macro indicators. You look at Europe, and the energy intensive manufacturing is down by double digits. The gas consumption is down, the oil consumption is down. And then we have China, one of the largest consumers of oil. They have built an inventory of 1.1 billion barrels recently. And This was the third month. May was the third month when they built their inventories for more than 1 million barrels per day this year. So China has been accumulating a lot of oil because China has become a really price-sensitive buyer. And I expect that in the upcoming months, the figures for Chinese oil imports would not be as impressive as the previous one. So that is certainly now we move from fundamentals, now we move towards the sentiment side. And that is certainly going to hurt the sentiment as well. You look at the recent positions taken, by money managers and hedge funds, minus the week where we had this war, they were also net bearish. So OPEC Plus just increased their production ceiling. People think they've increased their production. No, they've increased their production ceiling. But despite that, they've been adding more barrels into the market. The non-OPEC oil supply is also expected to stay strong, adding 1.4 million barrels per day in the coming weeks. Hence, I believe the fundamentals point towards a bear market. Oil prices are expected to go down. In the absence of this war, we would already be on our way to 50s, low 50s. But definitely it would be range bound. Brent would be anywhere between 65 to 70. I don't see Brent breaking 75 at all. Yes, unfortunately, there is a geopolitical flashpoint. It might touch those levels, but that would be contained and temporary.
Interesting point you make there, Osama. Thank you so much for joining in and weighing in on, of course, the global economic forces and, of course, on what the crude oil prices could be doing. Interestingly, as you said, 65 to 70, and that's a very narrow range that you put for next rest of this year. But we do understand that, yes, there is an oversupply and crude prices perhaps could be looking at further declines there. Really appreciate your time with us today. And with that, that's all the time that we have on the Big C. That's all from me and Nigel. Until tomorrow, we'll come back with more news and updates.